What is financial freedom and how do you obtain it? Is financial freedom the ability to pay for all your expenses with money left over? The mindset of knowing that you can retire today and you'll have enough money to survive for the rest of your life? Is it the ability of passing down generational changing money to your family when you're no longer here? Or is it the state of mind that one day I'm never going to stress over finances ever again? I believe it can be one or all of those things. But how do you get there? One strategy is the traditional work 40 hours a week and save as much as you can for retirement. Or maybe you can start your own business. Try to make it successful and sell it for a lump sum when you're close to retirement. Or maybe real estate, because that's always an option. It does create the most self-made millionaires in this country after all. All of those are perfectly fine, but I want to propose another strategy that you might not have considered before. A passive investing strategy called dividend investing. How's it going, everybody? It's the Unremarkable Investor back with you once more, talking about dividend investing. Now, this is something I'm very passionate about, and it's going to be a little bit more interactive with the definitions, a little more in depth. So I'm going to try to make it as easy as possible for you to follow, and I hope you can understand how I explain it. So without further ado, let's get to it. Let's define what exactly passive income is. Passive income is money earned with little to no active involvement. Basically, something is making money for you while you're doing something else. Other than you making sure whatever it is doing it for you is still functioning properly, it's really a hands-off approach to generating income. Now, with that being said, I believe dividend investing is the safest and easiest way to achieve steady passive income. And since I believe it's the safest avenue for passive income, I also believe it's the safest and easiest avenue to financial freedom. So let's talk about it. Dividends are a portion of a company's earnings paid out to its shareholders or investors as a reward for owning the stock. Look at it as an added perk to owning certain stocks. How dividends and other things for the business are funded is called cash flow. Cash flow is used for a variety of things, which includes investing in growth, new equipment, research and development, etc., servicing debt or paying down debt, daily operations like payroll, rent, inventory, share buybacks, which is the company physically buying its own shares back, and last but not least, dividends, or should I say dividend payments. So we've established where dividends come from, but how exactly do dividends work? When a company declares its annual dividend per share amount, which is a portion of a company's earnings paid out to shareholders over a one-year period, you find out how much you will get for owning one share of the company. Dividends are paid out on a few different time periods. You have monthly, quarterly, semi-annually, and annually. How you determine the amount you'll make at the end of the year for the stocks you own is simple. You just multiply the amount of shares you have times the annual dividend amount. Finding out the monthly, quarterly, etc. amount is the same way. If you go on websites like NASDAQ, Stock Analysis, Dividend Max, to name a few, you can find this total. It'll be under amount or cash amount, and it's the same process as stated previously. Let's say you have 50 shares of Coca-Cola stock, which pays every 3 months, and you have an upcoming dividend payment of 53 cents. To find out how much you're going to receive, you take the 50 shares and multiply it by the dividend payment amount, which is 53 cents as of April 1st, 2026. If you did the math correctly, you should get $26.50. It's pretty straightforward, and this is just in case you want a preview of what you'll be receiving beforehand. Next, you'll have what they call the declaration date. This term is pretty straightforward because this is just the company letting everyone know when they're going to pay you your dividend and when you must buy shares to become eligible to receive the dividend. This next point is very important. You'll notice something called an ex-dividend date. An ex-dividend is a stock that is trading without the value of the next dividend payment. But let's simplify that. If you recall, this is part of the declaration date I talked about previously. Basically, this is the company giving you a deadline to buy any shares before that date. This is because if you buy any shares on or after the ex-dividend date, the newly bought shares won't reflect on your next dividend payment, and your name won't be recorded on their books to receive a payment. This is reflected on their record date, which usually coincides with the ex-dividend date. So let's move on. Let's use stockanalysis.com for a quick example. We have the things that we talked about before, like annual dividend, which is $2.12, ex-dividend date, which was March 13th, 2026, and record date, which is the same as the ex-dividend date. We have two new terms here also I want to cover: dividend yield and dividend growth. Dividend yield shows the dividends paid as a percentage of the share price. Basically, the higher the yield, the bigger your payment will be. But be careful not to only chase after high yielding stocks. Usually, but not always, if a company has a very high yield, it has an unsustainable dividend. And unsustainable dividends usually lead to dividend cuts. So do a little bit of research before you decide to buy that 20% yielding stock. Dividend growth rate is the annualized percentage rate of growth that tracks how a company's dividend payments increase over time. The increase is directly correlated with the company's free cash flow. The company's free cash flow is the earnings of a company after they've covered their operating expenses and capital expenditures. The higher the company's free cash flow, the better it affects the dividend growth rate. Now, payout ratio is pretty simple also. It's telling you how much of the net income the company is paying out in dividends. Now, it's not always the rule, but you typically want the payout ratio to be on the lower side. It varies from stock sector to stock sector, so feel free to compare companies before you buy into one. Most sites show the previous dividend payments that companies pay out. Like I said previously, Coke pays quarterly or every 3 months. And as you can see, the cash amount is increasing each year. This is an example of dividend growth. So, not too complicated, right? Next, we have a site that I love using called Dividend Calculator. It gives me an estimate of what I may achieve in the future if I buy certain stocks that perform certain ways. Nothing is certain, but having a snapshot of what you could make in the future definitely is motivation for you to continue the journey. So you can set your starting principal, how much you contribute a year, starting yield, how much growth you think you'll have, and how long you'll be doing it for. Just to state this before I forget, how much you contribute is one of the most important things to consider, at least in the beginning stages. It helps the compounding effect and it speeds up the passive income process the more you contribute. Now, with the numbers I input, let's see the results. So we have the 20,000 principal here, the annual contribution here, we have the annual dividend yield. Let's just do 5%, it's pretty decent standard. And let's do a pretty good 7% dividend annual increase. And share price appreciation, 3%, leave it how it is. And let's do 30 years to invest. With all these input, I already hit the calculate button. So this is your portfolio after 30 years. Your ending balance, 3.1 million. Total return, 728%. Average annual return, 7%. Annual dividend income, the payments over 30 years, and yield on cost. We'll get into yield on cost at another time, but this is the one thing that I really want you guys to see. To know that you don't have to invest boatloads of money into this. The principal, what you start off with, the annual dividend, which means you made $1,000 by doing absolutely nothing. After taxes, the yield on cost, the after drip value. Now drip is dividend reinvestment plan. It's basically you just putting your money back into itself. The principal increase, the annual contribution, which will do $12,000 a year. This is just a good example of showing if you're by yourself, single, not with a family, if you can save $1,000 a month, which adds up to $12,000 a year. This is the example I'm showing you. So we have 1,700 here, 2,500, 3,000, 4,000. Let's go down to the 10th year. The 10th year, and this is all just estimates, you should be making a little more than $1,000 a month. So if we look down at the 17th year and 18th year, it's a lot of money, but over 18 years, 17 years, I think that we can all, if we're focused, if we're diligent, contribute this much. It's not outrageous amount of money, if you're putting your mind to it. And if we scroll down to 20 years and then we scroll down to 30 years, you can see the stuff compounds on itself and it does start to add up. Now, these are all estimates, and especially why these triangles are here. They're all estimates. This is just a snapshot, just something to keep you motivated, something to give you a look out into the future. Now, let's get back to it. All investing methods have their criticisms, and dividend investing is no different. Here are some common ones that people have when it comes to dividend investing.
I don't have $1 million to invest with. It takes too long. Dividend companies don't perform well when compared to other non-paying ones.
Well, let's approach each one. The median annual income for a single person in the US is roughly $3,500. If you Google how much money will I need to invest to make $4,000 a month in dividends, you'll most likely see a number that says between $480,000 and $1.6 million. But the thing is, that's if you invest all the $1.6 million in one go. If you invest over time, like shown in the example earlier, You only need to invest a little less than half of that. You just have to have patience. Speaking of patience, when people say that dividend investing takes too long, it's not a lie saying that it's a slow and steady wins the race type of strategy. But that shouldn't be a problem, especially if you're on the younger side. You have the advantage of time on your hands. And with time comes compound interest if you reinvest what you make. Your money starts working for you after a while, and it's only sped up the more you can contribute. For people on the older side, hopefully you can afford to contribute a little bit more on your account. And though this may not be your retirement, it definitely can help with it. Next, dividend companies don't do as well as non-dividend paying companies. Well, contrary to what you may think, companies that pay dividends are very common. And many dividend companies are on the Fortune 500. So let's compare a few that don't and a few that do. Let's use Amazon, Tesla, Palantir, and Netflix. Over the last 5 years, Amazon has done 37%, Tesla has done 76%, Palantir has done 559%, it's pretty crazy, and Netflix has done 94%. Pretty good companies, right? So let's compare them. Let's use Microsoft, Google, Apple, and ExxonMobil. Microsoft has done 58%, Google has done 192%, Apple has done 109%, and ExxonMobil has done 179%. Other popular ones are like Coke, Procter & Gamble, Walmart, Visa, and even Meta. Some of the companies stated aren't typically the top picks for dividend investors, but just to make the point, as you can see, they do compete with and sometimes outcompete other stocks. So with all that being said, why do I think this is the best pathway to financial freedom for everyday people like me and you? When you invest primarily into stocks with dividends, you don't have to stare at the prices of your stocks all day. You don't have to stress over the price going higher or lower, because if the company has good fundamentals, the dividend payments will be consistent and hopefully continue to grow consistently. That's the key to it. If you have a long way to go until you plan on retiring, the compound interest effect is at its best in dividend investing. Contributing even a few dollars at a time goes a long way when it's done consistently, because it builds on itself. And as it builds, those $100 a month dividend payments slowly turn to $200 a month, then $500 a month, and eventually $1,000 a month. It's also a solid and stable source of extra income if you already work a 9-to-5 job. So this works for all ages, because who can't use a little bit of extra money? So that'll wrap up this video about dividend investing. I hope it wasn't too complicated and pretty easy to understand for people that are new to this. The next video, I don't really have a topic for the next video yet. So we're going to have to just wait and see. But in the meantime, I'm glad that you guys took the time out to listen to me ramble about investing once more. This is the Unremarkable Investor. I appreciate it.